Let's face it, the crypto bull market sucked. While Bitcoin enjoyed its time in the sun, altcoins barely moved, which was disappointing to say the least. Take Ethereum's ETH, for example. Despite being the second largest crypto by market cap, it barely peaked above the all-time high from the 2021 cycle. And now that we're in a bear market, everyone is wondering how low ETH could go and what challenges it could face going forward. So, when a major research company released a report announcing they were bearish on ETH and were going short on Bitmine, the biggest Ethereum Treasury company, we knew we had to tell you all about it. Now that report is titled, quote, Ethereum, ETHUSD, What Vitalik Knows and Tom Lee Doesn't. It was published by Culper Research, which is known for its investigative deep dives. As always, we'll be giving you the juiciest details right here in this video, but we'll leave a link to the full report in the description for your convenience and reading pleasure. Now, the report starts by saying that today Ethereum has two core use cases, serving as the settlement layer for stablecoins and hosting tokenized real-world assets or RWAs. The report's authors explain that Ethereum is known for being slow and expensive, especially compared to competing chains like Solana. However, Ethereum's Fusaka upgrade, which was implemented in December 2025, increased the network's gas limit from 30 million units to 60 million units in an effort to enhance scalability. Keep this in mind for later. Anyway, the authors highlight the number of Ethereum transactions, which have skyrocketed since Fusaka. This typically doesn't happen when other major cryptos, like for instance BNB or Bitcoin, have major upgrades of their own. As such, many see this as a sign that Fusaka was hugely successful. In fact, Vitalik Buterin even tweeted in January that Fusaka had solved Ethereum's trilemma problem, meaning it can now achieve decentralization, security, and scalability all at once. And by the way, you can learn all about Fusaka in more detail in the video right over here. Anyhow, nobody has been more bullish on Ethereum's post-Fusaka future than Bitmine's chairman Tom Lee. Now, for those unaware, Bitmine is the world's largest Ethereum Treasury company. You can think of it as being Ethereum's own version of MicroStrategy and Tom Lee as Ethereum's own Michael Saylor. Case in point, Lee once predicted ETH could reach as high as $15,000 by, well, the end of 2025, and revised his target in December to suggest that ETH could hit as high as $9,000 by January this year. If only. In any case, Lee argues that the surge in active addresses and transaction count shows Ethereum's strength. He even said that, quote, Ethereum is not in a death spiral because utility is going up, adding that this reflects growing institutional adoption. But this report disagrees. Its authors argue that Lee is either ignorant or too blindsided to notice that the bullish metrics he cites are actually driven by bearish factors. And who do the authors turn to back up their bearish thesis? Why, none other than Vitalik Buterin himself, who has recently been selling a boatload of ETH. Vitalik announced in late January this year that he would sell over 16,000 ETH, declaring that, quote, the Ethereum Foundation is entering a period of mild austerity. The following month, he dumped over 19,000 ETH, and even at today's prices, that's tens of millions of dollars worth. Now, in fairness, the austerity Vitalik mentioned had two goals: speed up Ethereum's development to stay on track with its roadmap, and sustain the Ethereum Foundation long-term to ensure that development actually happens. And in our view, if ever there's a good time to focus on development, it's during the bear market we now find ourselves in. Regardless, the report's authors argue that Ethereum's apparent surge in activity isn't as positive as it seems. They even speculate that Vitalik's recent selling could signal that Fusaka may have broken ETH's tokenomics, something that permabull Tom Lee seemingly hasn't grasped. More on that later though. And by the way, if you're enjoying the video so far, then smash that like button, and if you want to stay on top of the latest Ethereum news, whether it's a major upgrade or Vitalik selling more ETH, then you can get our weekly newsletter sent straight to your inbox. That's where our research team breaks down the biggest stories shaping the crypto market and highlights key catalysts for the week ahead. And best of all, it's completely free. So why not sign up now using the link below or by scanning the QR code on screen now? Okay, so the next part of the report explains that the authors analysed on-chain activity on Ethereum, along with several major stablecoins running on the network like USDT and USDC. Their goal was to identify poisoning transactions, noting this may be the first time such analysis has been done, which is pretty wild. But what exactly are poisoning transactions? Well, in a nutshell, address poisoning is a scam where attackers send victims tiny so-called dust transactions from a wallet address that closely resembles the one they previously interacted with. This places the fraudulent address in the victim's transaction history, which can lead users to mistakenly copy it for use in future transfers. Now, on the surface, the odds of someone falling for this can seem extremely low. But because dust transactions are extremely cheap to send, attackers can target millions of crypto wallets and make a profit if even a small fraction of victims send funds to these addresses. Now, this is already pretty scary, but it gets worse. The report's authors explain that before the Fusaka upgrade, attackers focused on alternative blockchains like BNB Smart Chain, where transaction costs are much lower. Specifically, between 2022 and 2024, there were 252 million poison transactions on BNB compared to just 17 million on Ethereum, simply because BNB transactions cost only about a cent. But since the Fusaka upgrade made Ethereum transactions much cheaper, these attacks have become more viable. That's because the Fusaka upgrade lowered transaction fees by about 90%. Now, a poisoning attempt costs roughly 3 cents per address, higher than BNB, but still much lower than before. Considering the size of the Ethereum ecosystem compared to BNB's, well, it's easy to see how lucrative these attacks could become if attackers focused on Ethereum wallets instead. And if you're thinking, sure, it's hypothetically possible, but it probably won't matter, think again. According to the authors, quote, "Our analysis found that since Fusaka across both ETH and major ETH stablecoins, 95% of the increase in active wallets were those created explicitly for dusting or address poisoning attacks. Moreover, dust transactions now make up an estimated 18% of all Ethereum transactions, and that number is rising. In November last year, before Fusaka, there were just 4.4 million poison transactions, or 9.5% of all transactions. By December, this rose to 6.3 million, or 12% of the total. But in January, after Fusaka's deployment, poison transactions jumped to 13 million, over 18% of all Ethereum transactions. And by February, they rose again to nearly 14 million, more than 22% of the total. Now, the next part of the report takes a closer look at the direct impact Fusaka has had on Ethereum gas fees, starting with a pretty wild accusation. The authors explain that Vitalik's gigabrain may have miscalculated Fusaka's impact on gas fees. The report points to an initiative called Pump the Gas, or PTG, a collective whose focus is to, quote, educate the Ethereum community about the gas limit and how it can be used to help improve Ethereum scaling. PTG was a prominent voice for a gas limit increase, gaining the support of validators and even the Ethereum Foundation. The idea was simple. By increasing the gas limit to 60 million, this would theoretically bring transaction costs down by anywhere between 10 and 30%. And, as the authors explain, this theory was based on a formula that Vitalik himself came up with back in 2018. We'll skip the boring details, but essentially, Vitalik estimated that increasing the gas limit would reduce fees by 13 to 21%, in line with PTG's estimates. Instead, fees didn't fall 10%, 21%, or even 30%. No, they collapsed by over 90%. Needless to say, that is not a small difference. So, how did this happen? Well, the authors say the oversight comes down to two key factors. The first reason relates to an Ethereum improvement proposal from 2021, specifically EIP 1559. Basically, EIP 1559 changed how gas fees are structured and how validators are rewarded. The goal was to reduce congestion by increasing the block size and introducing a base transaction fee. However, the authors note that, quote, the elasticity estimates appear to have never been updated in turn. The second reason is that the Ethereum ecosystem is very different from how it was in 2018 when Vitalik developed that formula we mentioned earlier. Today, Ethereum is largely driven by Layer 2 solutions like Arbitrum, Optimism, and Base, many of which didn't exist until years later. Naturally, Vitalik's original calculations didn't factor these in, and it appears PTG didn't either. Whatever the case, the report's authors then show how serious the dust transaction problem is with first-hand evidence. They created 2 new wallet addresses and sent $500 from one to the other. In just 5 minutes, both were hit by poisoning attempts, with transactions from 3 separate wallets sharing the same first and last characters as the new addresses. Now, this is insane when you consider that wallet addresses are randomly generated and the attacking wallets had no prior transaction history. In other words, an attacker, likely using a bot to scan for victims, identified an Ethereum transaction, generated new wallet addresses until one closely matched the target, and sent a scam transaction, all within minutes. And if that wasn't crazy enough, the report cites research from Carnegie Mellon University, which found that more than 270 million poisoning attacks occurred between July 2022 and June 2024 across both Ethereum and BNB Smart Chain. Over 6,600 transfers were made to these fake addresses, earning attackers more than $83 million in illicit gains. But in just 2 months, between December 2025 and January 2026, Carnegie Mellon found that over $50 million had been stolen in the same way. And these attacks aren't going away. At the time of the report being published, the authors estimated that at least $348 million in crypto had been siphoned through poison address attacks. It's scary stuff, so stay vigilant out there. Now, the final part of the report argues that Fusaka didn't just open the door to the problems we've discussed. It may have also broken ETH's tokenomics entirely. The authors explain that because transaction fees have plunged on Ethereum, the fee burn mechanism has also weakened significantly. Now, this is a big deal because as more blocks fill with tiny dust transactions, essentially spam, larger legitimate transactions can enter blocks more easily. This means they no longer have to compete by paying higher tips to get prioritized. Now, on the surface, that might sound like good news for Ethereum users. But there's a major trade-off. With fewer tips being paid, validators are earning significantly less. This, in turn, drives ETH staking yields down, reducing the incentive to lock up ETH and secure the network, and giving validators less reason to keep providing that security. This not only threatens Ethereum's security, but could also hinder its institutional adoption. That's simply because institutions prioritize security above all else, especially for things like tokenization. And as we noted earlier, stablecoins and RWAs are arguably the biggest drivers of Ethereum's institutional appeal. This is a serious issue that's been debated for years, and that debate continues to this day. In fact, the authors claim that an institutional crypto advisor told them, quote, "If block space expands while demand remains stagnant, then the lower priority fees compress economics for validators, and if you increase capacity without increasing demand, you get lower or less deflation or even modest inflation." The report also emphasizes that even when Ethereum sees high activity, transaction fees no longer spike the way they did before Fusaka. Validators now earn less, and less ETH is now burned through these transactions. So, All of this points to one thing. Ethereum's tokenomics are now much weaker as a result of Fusaka. That said, some argue this may only be a temporary problem. For example, in January this year, Georgy Verbitsky, the founder of DeFi protocol Timeo, said that, quote, "It's basic supply and demand. Fees rise when many transactions compete for limited block space, and they fall when demand drops. Right now, we're simply seeing fewer transactions." However, the report's authors call this statement insane because transaction counts on Ethereum are at an all-time high. Another example comes from Leon Weidman, the head of research at Lisk, a platform developed to help developers build Web3 apps. According to him, quote, "What's different is that 2021 was a speculation-driven fee explosion. Now it's actual usage at scale. People are paying for real economic activity." Again, though, the report's authors call Weidman equally clueless, saying that what we're now seeing has nothing to do with real economic activity, but a direct result of dust transactions enabled by Fusaka. They also note that Ethereum's daily active validator count peaked in July last year. Moreover, while staking demand appears to be near all-time highs, most of that apparently comes from Bitmine. In other words, this demand is artificially inflated by a single entity. Without Bitmine, ETH staking demand would likely be only a fraction of today's levels. At the time of the report's publishing, the staking queue sat at over 3.3 million ETH, largely driven by the likes of Bitmine and other Ethereum Treasury companies who use staking to expand their reserves. These companies argue that ETH is deflationary and that staking offers a better return on investment than other assets. However, the report notes that neither claim holds up. While ETH staking offers about a 2.7% annual yield, US Treasuries, widely considered the safest investment, yield around 4.1% per year. On top of that, ETH is slightly inflationary at 0.8%. Now, given that ETH's value has dropped while Treasuries remain stable, Bitmine clearly would have been better off playing it safe. As such, the authors make a number of damning predictions about Ethereum's future. They note that ETH's inflation rate will likely climb higher than the current 0.8%, and that Ethereum will continue to lose mindshare to competing chains like Solana and could even be cannibalized by its own Layer 2 ecosystem. They note that this deterioration is already happening before our very eyes and state that, quote, "In the end, ETH holders will be left with little of economic substance. We are short and think ETH is headed lower." Oof. And with that, we've reached the end of the report, and remember, you can find a link to the full version in the description below. But right now, you're probably all wondering what this means for Ethereum's future. Well, while Fusaka seems to have done more harm than good, unfortunately, it doesn't end there. That's because there's also the upcoming Glamsterdam upgrade, which is currently scheduled for the first half of 2026. While Fusaka was focused on improving data availability for rollups, Glamsterdam will instead focus on censorship resistance and improving the efficiency of block building and transaction execution. But just like Fusaka, the broader goal of Glamsterdam is to enhance Ethereum's scalability. Now that's obviously a good thing, but Glamsterdam will also raise the gas limit from 60 million to a whopping 200 million units. Naturally, this could push staking yields even lower and could exacerbate the poison transaction problem we've already discussed. So, one last time, folks, stay vigilant. Transaction poisoning will likely keep growing until a fix is implemented, if ever. In the meantime, double-check that every character in a wallet address matches the one you intend to interact with. You can always verify addresses on sites like Etherscan to be extra certain. Don't take your eye off the ball, or you could accidentally send your crypto fortune to some scumbag. Now, the good news is that it's not all doom and gloom. Despite all of its flaws, Ethereum is still the largest crypto behind Bitcoin, and this isn't likely to change anytime soon. That's simply because the majority of crypto activity still runs on Ethereum, in DeFi, stablecoin transactions, and of course, RWA tokenization. In case you didn't know, around 57% of all tokenized RWAs live on Ethereum. Meanwhile, institutions prefer Ethereum because it's provably more robust and secure and has never suffered a major outage, unlike competing chains, looking at you, Solana. So, taken together, this suggests that ETH's price will eventually appreciate, current market conditions notwithstanding. That said, the current bear market could be a long-term positive for Ethereum. That's because, historically, these periods are when developers really knuckle down and focus on building innovative solutions. The next killer app could emerge in the coming years, introducing new tech or solving existing pain points, and Ethereum is the logical platform given its outsized market share. So yes, admittedly, things aren't looking great right now, but we reckon this pain is temporary. If Ethereum's developers have shown us anything over the years, it's that they are the best in the business. And while none of us at the Coin Bureau are coding wizards, we'd bet that a fix for the poisoning problem could be out there somewhere. That said, today's report has certainly highlighted some fundamental problems Ethereum needs to address, and quickly. If left unresolved, Ethereum could face serious issues and even be pushed down the market cap rankings by competitors. But, fingers crossed, it never comes to that. Okay, folks, that's just about enough from me, and now it's time to hear from you. Are you worried about Ethereum's future, or are you planning to stack ETH at a discount in the bear market? Let us know in the comments below. If this video has you wondering what happens if ETH goes to zero, then check out the video over here. And if you want to know more about why Vitalik has been dumping ETH, well, you can find out in this video right over here. Okay, thank you all for watching, and I'll see you again soon. This is Guy, signing off.